Welcome to a brand new series that we're starting talking about Airbnbs slash VRBOs slash short-term rentals. We're talking about all the ins and outs, the how to find it, what to do when you have it, all that good stuff. We're going to have a whole series on this as we're buying our first one. My wife and I are buying our first one. We're closing at the end of July 2022. It's going to be the beginning of building our portfolio of short-term rentals. But that being said, I want to start all this off with talking about why. Why does it make sense to buy a short-term rental? That's a good question. This is Steve with the Malone Realty Group at EXP in the Atlanta area. Now, again, I'm in the Atlanta area, but this can work for anybody looking to build wealth or to pick up a vacation property, for all the different reasons. But there's all kinds of things that you can invest in. Okay, you can obviously invest in the stock market. You can invest in real estate. You invest in crypto, whatever you want to, To me, when it comes to what do you invest in, you should always invest in things that you understand. Okay, I'm a big Dave Ramsey person. Now, a lot of this stuff is going to be not quite Dave Ramsey principles, so my apologies to Uncle Dave, as I call him, but still very much the Dave Ramsey principles of if you understand it, then you should be more comfortable investing in it. If you don't understand it, probably shouldn't throw your money at it. For example, I know base level stuff about crypto. I see what Bitcoin does, and I hear of all the other crazy stuff. There's a lot of people that I know that know a lot more than me, and they dive in, they dive out, they dive in, they dive out, and that looks like fun. I'm not touching it because I don't understand it, okay? I could learn it, that's fine. I understand real estate. Been in real estate for 5 years. I know the ups and downs. I know what the market's going to do. I'm also a child of the internet, so I know how to harness the power of the internet to create websites to, bring people to your thing, or harness the power of websites that are already there, like VRBO or Airbnb. This all makes sense to me. So to me, stock market makes sense, but when you ask me stocks versus real estate, I understand real estate a whole lot more. I feel much more comfortable in this. Because right now, as we're recording this, July of 2022, the rates are going up like crazy. A lot of people are pulling away from real estate because they're nervous about it. They're running out of the burning building. Me, I'm running into the burning building because everybody's leaving. It's a great time to run into a burning building. There's nobody there. Yes, I'm a little crazy, is what it is. But I have made the choice that I would like, to start investing in real estate just because I understand real estate. I understand how it works. So that being said, why does it work? Okay, so let's talk about this. This could be a fancily edited video. It's not going to be. It's just going to be me talking. So my apologies ahead of time. Just imagine this kind of whiz-bang stuff going on. And then you can imagine the amazing editing. Now, maybe if we get a whole lot of hits on this, maybe we'll edit it a little bit more. But for now, 5 reasons why a short-term rental makes sense for us. All right, number 1, your equity in your main house is dormant otherwise, okay? I got a coach who talked about on a video that he did. He likes to tap in his home equity to get short-term rentals, to get other properties and whatever, because he feels like if you have equity in your house and the equity is just sitting there, that equity isn't making any money. Like the dollars, they're just lazy. They're just sitting there, not doing anything. So he likes to pull the equity out and go and grab something else. Now, here's the thing. If you have $100,000 in let's just say Amazon stock, just picking a giant company. If you have $100,000 in Amazon stock, right? And you take $50,000 out of Amazon stock and Amazon goes up, it only goes up for the $50,000 that's left, right? Right. Because you took $50,000 out. $50,000's out of the game. You're only making money now on the $50,000. Now, if your house is, let's say, worth $500,000, okay, and you take, let's just to make it easy, you take 50 of that. So there's 50 off of that. If the house goes up in value, it's going to go up in value from the 500 the same exact amount, whether you pulled 50 out, whether you pulled 150 out, whether you haven't pulled anything out, whether it's completely paid off, whatever your loan situation is over here, that growth on the 500 is just going to go off the 500 number, regardless of what goes on in the loan. So that being said, if you take money out in the form of a equity loan or whatever to pull the equity out, guess what? that's not going to affect what that home is worth going forward. It's not going to affect how much that house gains. Now, obviously, yes, you've taken out a loan. Okay, so keep that in mind. You want to be very smart about it. I've talked about this before. You don't want to take out a home equity loan to pay off credit cards. That's a bad idea. But taking out a home equity loan to improve the house or to maybe purchase a second house if you know what you're doing, to me, makes sense. Again, that's where I'm going to differ with Dave Ramsey. I'm going to kind of tap more into the Robert Kiyosaki principles, as he's over my shoulder right there, Rich Dad Poor Dad. That's what got this whole ball rolling. I was reading that goofy book. Like every other realtor, now everything's crazy. Now we got to go get some assets, okay? So that's what we'll talk about next. But equity is dormant in your house, okay? Tap into that. Get those dollars working for you, okay, to start building your nest egg. That's number one. Number two, it can pay for itself. That's what we're planning right now. What we're planning is we're going to purchase this Airbnb / VRBO. I call it an Airbnb. Really, it's a short-term rental. It'll be on the Airbnb and VRBO platforms, but everybody seems to call their little getaway cabins an Airbnb. So we're just going to go for it. We'll call it an Airbnb. So just know, going forward, when I call it an Airbnb, it's interchangeable for all those things. We're planning on putting it on Airbnb and VRBO. Looking at the track record of this particular property that we're buying, it has made well over the amount that it takes to run it every month, from the mortgage to the electric to the internet to the whatever. It costs this much to run it. They bring in this much per month. So there's actually a little bit extra every month that's going to be on it, which we will then put in the bank for a rainy day, just in case there's an issue, whatever. The goal is to make some cash flow off it, but to have it pay for itself over time. So, unlike if you put $100,000 in Amazon, again, we'll use the Amazon, what can you get? What can you do that you don't have to put the $100,000 in Amazon? It's just $100,000 that goes in Amazon on your behalf, but you don't have to pay for it. Yeah, obviously there's some stuff you have to do to set up and whatever, but if you can set it up right to where you get the right place that actually pays for itself, all of a sudden you've got an investment that you don't have to worry about, right? That you don't have to worry about putting money into because you have other people helping you cover the costs. That's why you want to have a rental. That's why we're doing a short-term rental. We'll do that video at a later date, why short-term versus a long-term rental. That's number two, it can pay for itself. Number three, we're creating assets. Again, we're getting back to Kiyosaki over here, over my shoulder. So I'm reflecting on him. There he is, Rich Dad Poor Dad. So Kiyosaki says, you want to create assets. Assets are things that you have that pay you. A liability is things that you have to pay towards. So theoretically, your main house, you may think it's an asset, but technically from his standpoint, assets versus liabilities, it's a liability because it doesn't pay you. Assets pay you. So you want to get in the mindset of creating assets, creating things that actually pay you. So even if this house, all the money that we make off it, we pay off the bills and whatever, even if the cash flow of it is $1 a month, it's worth it. Because $1 a month and the equity is going up on the back end. So down the road, we'll be able to sell it for much more than we're buying it for. So we're making a little bit of cash flow and the home is gaining equity. Okay, so you want to start thinking so for us, we're creating an asset, number one. Number two, we're also building the habit of looking for assets. Okay, and that's what we want to look for, because now that we're doing this, now we're thinking to ourselves, okay, well now we're going to manage this ourselves and maybe get a second one, in a year to 2 years and manage that ourselves. And all of a sudden, could we create a management company since we're already doing it? We've already built the machine, and then the management company, people would hire us to, all of a sudden you start thinking things differently. Okay, so you got to get in that mindset. So that's the cool thing about it. You're creating an asset. You're getting in that mindset of creating things that pay for themselves and actually pay you as they run. All right, so that's number three. We're creating assets. Number four, it doubles your equity for the next one. What do I mean by that? Maybe it doesn't quite double the equity, but what it does, instead of you having one house that you have equity in, now you have two houses that you have equity in. Okay? Now again, a lot of people are going to look at that and they're going to say, oh, that's I'm nervous about that, whatever. And that's fine. If you're nervous about that, don't do it. All right? But to me, if you have equity in one house, you can use that equity to do whatever. But then you get a second house, and that's building up equity too. And over the next 2 years, these will both build up equity, allowing for us to maybe do something else in a couple years. And then I'll have 3. Run out of hands. But imagine a third hand. We'll have 3 houses, right? So the 3 houses will each start building up equity. And again, we just start building. And again, by doing this smart, by picking the right place, we're setting ourselves up to where other people can help to pay for the asset that we have done. Now, again, we're going online by purchasing this, by insuring it, by doing all of that stuff. So we're putting our butts on the line, which is why we get paid that. But if you know what you're doing, and that's why I said when you're investing, you need to know what you're investing in. I know real estate. I know the game. I know about the Airbnb and VRBO thing because I'm ingesting all of that right now. So this is a smart play for me. If you don't know it, it may not be a smart play because you've got to be sure that you pick the right place that is able to be rented. Okay, that's going to be the thing we talk about in our second video. We'll talk about that next week. But right now, I just want to talk about the whys. So again, that's number 4. You're doubling your equity play for the next time because you're going to have 2 houses building equity, and then you're going to have 3, and so on and so forth. Okay, number 5. All right, so again, 4 things one more time. You have that equity is dormant, so you want to tap into your equity that's just sitting there. Number 2, it can pay for itself. Okay. Number 3, get you into the habit of building assets and thinking in that different mindset. Number 4, you'll double your equity for the next time. Number 5, we're through the adoption curve. What does that mean? 10 years ago, 15 years ago, if you were going somewhere, if I was going somewhere 10 years ago, if I was going into a city, I'd look on hotels.com or look on Priceline or whatever, or I would go, if I was going to the beach, I'd go on VRBO. There's some other places on the beach that you can go to, some of those little rental places, but probably just go VRBO. VRBO has been around for a while. But now Airbnb is out there, and it's allowing for more of those, again, B&Bs, more of those little cottages, little things like that to pop up online. That was a couple years ago that started. We're through the adoption curve of that. What I mean by that is I don't have to go in there and say, I wonder if this Airbnb thing is going to catch on. I wonder if the VRBO thing is going to catch on. If people are going to, they know it's there. You know Airbnb is there. You know VRBO is there. All the other sites are coming online. The internet type, app-based rental programs are there. They passed the test. They made it through the dip. They're good to go. Okay, so you don't have to worry about, I wonder if we can get, the only thing that's going to keep people from coming and renting your place is if you don't do a good job getting your place rented out. And that's it. Okay, so again, that's what we'll start talking about next time, is what to look for, what we looked for. I want to just kind of put this in our frame of, this is how we're thinking. But those are the big 5 for me. That 5th one being, we're through the adoption curve of, can we do this? This is absolutely going to work if you do everything correctly. And if we do everything correctly. So we're going to do everything correctly and see what happens. If this is a complete train wreck, I'm going to come on here and tell you it's a complete train wreck. Okay, but now I will give you, again, Rich Dad, Poor Dad. If you've never read it before, by Robert Kiyosaki, it is a quick read. It's a very cool read. It's very high level. It's not very much kind of, hands-on, like this is what you should do, but it gets your mind thinking. He has some other books where he talks a little bit more about what you should do, but getting in the mindset of 4 greenhouses, 1 red hotel. If you read it, you know what that means. Read the book. Get you in that thinking of, especially now with the cash being with inflation being as crazy as it is, taking that cash, which is overinflated, and using it to buy assets, kind of getting it out of cash and putting it into assets that are going to start paying you, start building your wealth, things like that. You're starting to pick up pieces, okay, instead of having all this overvalued money. Now let's start trading it in for things that are not overvalued. Real estate, yes, it had the big drop in '08. That's really one of the only times it's done that in the last 100 years, okay? I'm not worried about real estate going down in value. It's going to keep going up, and even if it goes down, it'll bounce back, okay? They are not making more real estate, okay? So things are going to improve in real estate. That's why I think it's a smart play all the way around. If you have any questions, If you think I'm full of crap, put it in the comments. If you have questions, put it in the comments. Let me know. Love talking about real estate. Love talking about this. It's kind of the new gig. And we're going to have updates, every week or every 2 weeks talking about our Airbnb / VRBO / short-term rental and how we're doing and what's next and all the good stuff. So again, this is Steve with the Malone Realty Group, EXP in Atlanta. We'll talk to you. Bye.